Welcome to Peachtree Point of View with Greg Friedman, the podcast that shares insights and strategies to navigate dislocated markets and capitalize on mispriced risk. Today on the Peachtree Point of View podcast, we're bringing you our quarterly market update. Peachtree CEO Greg Friedman discusses the commercial real estate market with MSCI's Jim Costello, head of real estate economics and chief economist. Let's jump into their conversation.
We're excited to have you join us today on the market update call. I know the market is moving very quickly. Whatever we talk about today may be less relevant a week from now, especially with how the new administration is going about life, chaotic and volatile. Would love to get your thoughts, on the market. I know you have probably some slides you would like to share and stuff like that, so I'll let you kick it off.
Yeah, and honestly, if anybody wants slides, they can reach out to me afterwards. I got a ton of slides, but sometimes just a conversation can be better, especially in this kind of environment where things are moving so quickly. But the story that has struck me on recent travel, just going to different industry conferences, talking with professionals, there had been this saying that was out and about in the world: stay alive until 2025, because we had this interest rate shock of the 10-year Treasury going from 60 basis points up to the 4 range, and then coming back down a little bit with inflation cooling. But that shock made it difficult for a lot of properties that people had bought at too low of a cap rate at times. It made it difficult for folks to continue to make payments on that. And the notion was, if we just keep it together, we'll get bailed out with some price growth, some stabilization, just make it to 2025 and we'll be okay. And if you look at the first quarter numbers and everything up until February, it looked like we're on that path. Investment returns were trending towards a positive direction, if not positive, for the equity portion of the stock. Asset pricing itself, even offices and the CBD offices, and especially the expensive coastal markets that had so much trouble following COVID and following the interest rate shock, even those areas, we're starting to see some positive momentum. Even if there's some price decline still, they still have positive momentum. I mean, it wasn't getting worse anymore. It was on a path to growth, and everything was looking like we had survived into 2025. But, the attitude of folks I've been talking to of late has been that we've had the rug pulled out from under us, that with some of the economic turmoil and some of the uncertainty that's causing, that all the assumptions that people had made about growth and surviving are starting to unravel. Now, I think the challenge is one of just the downshift in expectations. I mean, you go from this world of like, oh, it looks like we're almost back to growth, almost to profitability, almost to surviving, to more uncertainty. And you get that emotional reaction of just feeling despondent. And so I think there's sort of that shift is impacting people. But, what the way I look at it is, you got to turn around now and just think about, oh, great, it's a new reality. How do I make money in it? And that's what I think is really the focus that people should have. How do I play this new part of the cycle, which is particularly difficult because there's no data yet. This is what's maddening. The news cycle is moving so fast in this environment. Minute to minute, things change. I feel like I should get a widget on my laptop and just have it, off the side, just constantly showing what new policy things are coming from DC that suddenly roil the market extensively that day. But with the news cycle being that fast, in real estate, we get quarterly performance for real estate. If we're lucky, there's some other high frequency indicators. You look at some monthly data, but there's not a lot of good performance data. So none of this shows up yet. But this is where I think our appraisal practices in the United States need to step up their game. And for instance, after the financial crisis, think of London and New York, two very similar markets, very similar economic drivers, very similar investor bases in each. When the financial crisis hit, the same shocks and the same kind of markets at the same time. It took a full year before appraisers marked cap rates down in Manhattan versus central London. It was nearly the same time. The appraisal standards, it's not like they had cap rates data that they could look at. They didn't have transactions. But the appraisal standards allowed them to look at other asset classes a little bit more and bring that into their appraisals and make sort of a judgment of what the reality would be for the market to clear. And so they're able to reflect that more. if we have a period of economic weakness from all the trade turmoil, if that does come into the summer, it may not show up in any appraisals for some time. So that's going to be challenging. So in that kind of case, what I think people need to do is look at other asset classes to get a sense of how the investment world is functioning. And from that, even if your appraisers aren't giving you all this information yet saying that, hey, the value has changed, I think you have to evaluate it in the context of what's happening in the public markets so that you can see the impact of the shock, be ready for it as opposed to being catching later. So the key indicators that I've been looking at myself in the last few weeks, the first and foremost indicator I look at are corporate bond rates. So let's think for a second about what real estate is. It's the box where the economy lives. Okay. So if you have some economic weakness, my fundamental demand for real estate is to drive demand. People need to have places for their office workers to sit. Maybe less so in the past, but they still have that need. They need a place for goods when shopping, if it's the shopping that's done in store as opposed to online. They need hotels for the room nights when you're traveling to conferences. I'm in that all the time. All that stuff is part of the economy. So, how do these firms get valued? These tenants, how do they get valued? Well, the public markets do a really good job of valuing the debt of these corporations. Let's say you have a whole bunch of office tenants in a building. The corporate bond market goes in, looks at the risks of each, figures out just how likely they are to repay. And those corporate bonds, since the turmoil started, the spread to the 10-year Treasury has gone up. It had been around 140 basis points, meaning that corporations and average corporate risk relative to 10-year Treasury, they wanted an extra 140 basis points on top of it because they thought they were riskier than the government. It was kind of a stable level, and that was actually low. But it surged. It went up for a little bit to 200 basis points, a 60 basis point increase. It's down now to 185. But let's say it's a 40 basis point increase roughly. If that stays, and it's not clear it will, but if it does, then if the public markets are saying that the income streams tied to the debt from these tenants, firms who happen to be tenants in a lot of commercial properties, that the debt is riskier now than before because of the potential economic weakness, shouldn't you look at the income from their rental payments as more risky as well? And so, that should put upward pressure on cap rates again, just at the time when cap rates are starting to go down or starting to level off a little bit. So that extra riskiness, it could add maybe 40 to 50 basis points to cap rates from where we are today.
One question, because it's sort of a very interesting point bringing up the corporate bond rate. So when you're saying, so normally it was 140 basis points over the 10-year is where these tenants, where their debt was being priced. When did it spike to effectively being over 200 basis points? When was that time period? Because that's sort of interesting. Is that something that just happened when the tariffs discussion really hit off? Is that what was the driver of it, I guess?
Exactly. So it started on April 2nd, that kind of initial shock. And it's just it was up sharply for a bit. It has come back down, but there has been some retrenchment. And let's hope that continues. Let's hope more stability comes, because then you can't make decisions easily in the face of uncertainty. But now you're up at around 185 basis points. The question is, what's it going to take to get back down to the kind of 140 basis point spread, which was kind of a low level relative to history? It said that we were kind of in a risk-on environment, and it was the time to start thinking about taking on risk. But it's not something that you'd want to see in this point where you're just getting a tentative recovery in prices and returns. The timing of it is not favorable for folks who had been playing this stay alive to 2025 game.
Right, that makes sense. And then is there any correlation to the corporate bond rates to when you look at cap rates across, there's, it's the risk premium spread or the spread, on the corporate side, 185 basis points, but is there something that equates to commercial real estate? Or you're not seeing a lot of trades, so I don't want to say that this is usually the market, but you are seeing some trades where people are buying assets at still these cap rates that are, in the 5% range or even lower. You scratch your head because if the 10-year, you believe the 10-year is going to be about 4%, for a prolonged period of time, you just don't have a lot of risk premium spread. You're almost better off owning the corporate bond, 185 basis points than buying something that's only got, if it's sub 5, you got less than 100 basis points of risk premium spread.
Yeah, this is what's interesting. There's a couple of threads to pull apart there. Number one, think about how long it takes to close a deal. There are deals underway that started well before some of the recent turmoil. So some of them are closing and just going through with what they had without a retrade. People know that, okay, maybe things aren't looking as good, but I got my financing lined up. And, some of those folks, especially like in the apartment world, were probably underwriting stronger growth in the future. So that's one way through paying low cap rates on deals. And, had things gone the way they were, maybe that assumption of stronger growth in the future made sense. Today, you'd have a harder time getting a lot of folks to, agree with that kind of underwriting, but that would be for a deal starting today. So there's a difference between sort of the lag. And so we're going to see some stuff still trickle in where all the underwriting, all the assumptions were tied to lag deals. So it'll be a couple of months before we start to see a slowdown impact from all this in terms of deal activity. It's just the lagging nature of the sector. And that's why I think we really need to, as an industry, look to other asset classes as a bit of a guide in a period like this to understand some of the risks we're actually facing. Because if you're just trying to look at the world, thinking about it deal by deal, my maybe I shouldn't be saying that. My company sells a lot of deal level information, right? But I think you need to look beyond just individual deals to get a sense of pricing and the risk appetite and what happens to folks, how folks behave. In terms of just the question also on the correlation of like cap rates to corporate bond rates, yeah, I mean, they'll correlate highly. Like if just when you're done here, just grab a cap rate series and throw the Moody's Baa bond index. It's available on Fred. It's series Baa. You just throw them into a spreadsheet and they'll have a real high level of correlation. Like think about the cap rate as just another point. It's not apples to apples, but it's kind of like think about it like another point in the yield curve. All of those things kind of correlate in levels over the time. The key thing is understanding the spread relative to other asset classes. And that doesn't always 100% correlate. That's why, some people look at what's happened in a 10-year? That's where cap rates should go. But no, there's always a varying spread that changes over time based on just how risk averse people are at different periods of time. And the other thing that makes them feel like they can take on risk, I kind of alluded to it earlier. Sometimes you could do the sub 5 caps if you're underwriting stronger income growth. And so that could be an offset if you think we're done and we're going to see some great growth. That could be an offset to the higher financial risks. But that's the challenge out there, trying to look for the growth that comes from all this. And it's going to be a tricky period of time as people try and figure out how to rework supply chains.
I feel like before new administration came in, there was huge optimism and there was going to be all this growth, and then just had this, I feel like, constant chaos and volatility. They're doing a lot of things that needs to be done. Maybe there's a better format in doing some of this stuff. They're trying to accomplish a lot of things in a very short window, which makes it very chaotic and probably minimizes the good that they're really trying to accomplish. Because people don't fully appreciate it because it's just creating all this volatility. Probably could be done in a more efficient manner and probably have a better strategy around it. But take that off the table for a minute. That's obviously stunning. It's creating a lot of pessimism. It's probably going to create negative growth. It's probably potentially creating a recession. Probably didn't need to exist, theoretically. Do you see anything that could be on the flip side of the equation, like the new tax bill? There hasn't been as much, at least haven't seen as much discussions about it over the last couple of weeks. I feel like if all of a sudden you got the new tax bill, does that change, I think, the outlook of investors or how you would view the growth in the market at the asset level for performance?
Yeah, you bring up a good point. There was a lot of optimism when the new administration came in because there was talk of more efforts towards deregulatory type activity and a more comprehensive look at tax policy. And that the hope I had on tax policy was something like in the past when we've had major changes in tax policy, the one thing that tends to happen, it's like going in and just clearing a field. You got a bunch of bramble and just set it afire and just clean everything out, get rid of every exception, every little special rule that somebody had, and just go back to a clean slate like we've done with some other tax policy stuff in the past. That's the kind of thing I was hoping for. And maybe if they had started on sort of the things that were going to be the positive messages first, maybe that would have got them some wins. It's hard for us. I don't want to be the Monday morning quarterback. That's not a role I want to play. But it is interesting that there are a lot of things that people were optimistic about. The deregulatory stuff in particular is something that I think that if anybody here has the president's ear, have him lean in on that, because that's the kind of thing that it's a gift that just keeps giving beyond tax policy. If we make it easier for firms to do stuff, think about apartment development. The NMH, National Multi-Housing Council in DC. Now, it's not a federal issue, so the president really can't impact it, but regulation adds about 40% to the cost of developing housing. All kinds of restrictive zoning, all kinds of review and design oversight issues. 40% of the cost. Reducing regulation, we could solve some of the housing challenges we've got. But that's the kind of thing that would be helpful if they lean in on that. Another one that they could lean in on, one success of the first Trump team, I have some research coming out in this soon that shows opportunity zones. If you look at apartment construction in the United States, inside opportunity zones versus the rest of the country, it grew faster inside those opportunity zones following the introduction of that regulation. So who knew? When you give developers tax credits, they build more. So, that was a successful policy. So, if they had, tried to lean in on that as well and follow up one thing that was actually successful from the first Trump administration, that would have been my approach. But maybe now they can start leaning on these things, and maybe that's helps to start stabilize some of the fears that are out there.
Jim, quick question here, just regarding the current administration's policies being generally inflationary, but also having a desire for a lower interest rate environment. Can you get your take on how that kind of works together, or it's antithetical? Any perspective there would be helpful.
Yeah, they don't work together, period. And we had this golden period of economic growth with low inflation following the Clinton years into just about the housing boom period. And that was all from just the United States being able to export inflationary challenges overseas through trade. And that, trading system allowed us to keep cost pressures under control. I mean, effectively, it was just a lot of trade with China. Now, there are some deeper policy goals there that maybe you don't want all your manufacturing activity happening in China. And so anytime you do that, it will definitely be inflationary for at least a bit as you try and figure out, well, where will the new supply chains come from? Where will new goods come from? Where are the factories going to be? How is all that infrastructure going to be built? It will, for a time, be inflationary. There's just no way around that. Now, if you want a low 10-year, the issue there is that it was low in part because we were trading so much with other folks. When we import goods from overseas, those folks need to buy dollars. They need to buy dollar-denominated assets. They have to recycle the money they're making back into dollars. So, when the Japanese talked about stepping back from buying the 10-year, and we saw the spike in the 10-year Treasury following that spike helped the policies to cool a bit. And we need that trade if they're going to be buying dollars and keeping the 10-year Treasury low. So it's a tricky web there. You just don't instantly have a low 10-year Treasury. And the trade has actually helped keep it low. So trade has reduced inflation and kept the 10-year Treasury low. Now, it does create this issue of we do have a borrow and spend economy here in the United States. Our savings rates are at a record low, and that's a challenge for us. So there is a desire to change all that, but change doesn't come without pain. You can't get out of this long-run low inflation environment into a new one right away. It takes time for things to change and figure out how you can get inflation under control through exports like we did in the past. So the 10-year, if you get rid of the thing that kept it low, both in terms of keeping low inflation and creating a need for other countries to buy our debt, it just doesn't seem likely that the market will accept a low 10-year. And that's where the focus should be. It's nothing to do with the Fed. The president has been railing against Powell at times, and he just sets the Fed funds rate. I mean, even he doesn't do it. It's the Federal Open Market Committee. But let's say he does control the Fed funds rate. That doesn't impact the 10-year. It's the 10-year is impacted by the market. You can't control that market.
You all have any house view when we wake up 5 years from now where you think the 10-year will be?
If I could reliably predict where the 10-year would be 5 years from now, I'd be living on a beach in Bermuda.
Yeah, exactly.
But I will say this, the level we're at today, it's actually weirdly not so high compared to where we've been historically. There's a whole generation of folks in our real estate investment world who have only had careers that have started in this period of free money that followed the global financial crisis. I mean, anybody who started from like 2007 onward, and I mean, we're coming up on like 20 years since then. There's a whole bunch of folks senior folks in our industry, who have only been around in this period when interest rates were at record low levels. And that's going to create some challenges downstream, but it also has an educational challenge. The educational challenge is that people need to think about what is a normal interest rate environment. It's not what we've had since 2007 and since all the QE stuff distorted the opportunity for investment worldwide. We started entering a quantitative tightening cycle like in 2017. By 2019, people were talking about a potential recession in 2020 from just the higher cost of debt. And then we did actually have a recession. It was for another reason. And then they piled on more free money as the medicine to solve that. And now we're having even more withdrawal symptoms from all that. But it's something that people need to get their heads around, that the low interest rate environment that we saw from like 2007 to 2020 or 2022 just isn't normal. What's a 5% is more like a normal environment. A great example, FFC the other year talking with some very senior in our industry, not senior in terms of age, but senior in terms of responsibility, folks in the lending world, thinking that, once we get through this period of turmoil, we'll get back down to a 2% 10-year Treasury, because that's what we've seen on average since we've been working and since it's coming back. But it's the key thing is, since they've been working, you need to go back to a period of time before all the turmoil started from the financial crisis. And this is what's bizarre. We're still responding to that. These shocks have long lives. I think we're no matter what, we'll be in a higher interest rate environment over the next 5 years than we were since 2007. And think about what that means. On average in the United States, commercial real estate investments are held for about 7 years. So when the 10-year falls, now the 10-year and cap rates and mortgage rates, they don't move in a 1-to-1 ratio, but they rhyme. If the interest rate environment is falling, on average, everything else equal, you start to see falling cap rates. Let's hold on to that 7-year figure for a second. From 1985 until 2020, interest rates were falling dramatically. Any time in that period that you bought a building, you were buying it from someone who 7 years earlier bought it in a higher interest rate environment. So they probably bought it at a higher cap rate and a higher mortgage rate. So that whole period of time from 85 to 2020, now there's some periods of time you could buy assets and lose, but on average, when people bought, capital market forces were generally a tailwind driving performance. There were cases where people could buy a property, mismanage it, have income not at a decent level, and still eke out a positive return in the end, simply because of the cap rate compression that they went through along the way. Sell it on to that next person, a lower cap rate, and it papers over a lot of mistakes at times. That game is over. 5 years from now, unless we get some new shock that takes the 10-year Treasury back down to that 2% range that people are hoping for, if we go into this world of just no more QE, the market kind of determines where interest rates are, probably going to be a higher interest rate than anything we saw since 2007, which means that when you're acquiring properties, rates are not going to be your friend. The capital market forces are going to be a headwind moving forward, not a tailwind. And that changes how you make money in real estate. The number one thing is going to be managing your properties effectively moving forward. If you can't count on cap rate compression on exit to help boost your return in the end, where you're going to get your return is from that initial purchase, making sure you're getting it at the proper yield, don't overpay, and then just manage those assets much more efficiently than the next person. Just make sure that you have the right tenant mix. Make sure that you're not going overboard on CapEx spend relative to NOI, relative to your peers. And when I give this talk at like universities to the real estate kids getting graduate degrees in real estate, I tell them actually I'm excited for them because it's going to mean that they can be actual real estate people now. That
Right.
They're going to be not thinking about financial engineering so much as just how do I get this property to focus the best. This can be more singles and doubles and fewer home runs at times, but it's going to be a harder slog, but it is the way to go. I think there's going to be some real opportunities in that to focus on the fundamentals and just manage everything properly.
It almost feels like we've gone from this decade of overperformance. You're in this 0% interest rate environment where a lot of people have never seen a normalized, because this is more of a normalized interest rate environment. I think your point earlier where the 10 years not really that high relative to history, but people made a bunch of money just through cap rate compression, their debt costs coming down where they were able to sell assets. And now we're in this period of time where in real estate overperform on the equity side when you're investing. Almost have now transitioned to this decade of underperformance, because from a macro perspective where it's going to be very valuable for the group that locally really understands the market, knows how they can go fix the asset and manage the asset or operate the asset more efficiently. This is where those groups are going to be benefit the greatest. In the days of and I hate to pick on groups, but some of these larger private equity groups that tend to put out a lot of money on a trade, it's going to be very hard for them to do the performance that they did back during 2010 to 2022, because it's much harder, because you're going to need someone that's more of a rifle shooter than a macro trader.
Yeah, although some of the private equity firms, I think we'll still see entity level purchases at times. There's still value at times in consolidation for industries that are maybe, especially like mom and pop groups that have gotten big, but they're still kind of operating like a mom and pop group and not efficiently like a privately run, like a publicly run entity. So some of that take private from type activity, I should say. There's some of it can happen from just an organizational improvement, and then some of it too consolidating industries when you get a whole bunch of investor excitement about a particular niche property type and everybody jumps in. Sometimes the way to do that is through A-type deals. So there's still going to be activity, but it's not going to be as easy because you can't just buy a whole portfolio and then spin off a few properties that don't work well, because it's not just going to be as cheap and easy to do that.
So, this newer era of commercial real estate, with everything we're talking about right now, or this new interest rate environment where the 10-year, because you think about 2010 to 2022, at least the 10-year average, I think around 2.2 or something. Today, it's obviously almost double. I mean, I think it's down to 420, but still almost double. Is it, as the market continues to sort of recalibrate or reset to this level, especially growth is going to be what happens from the new administration perspective, or what they're able to years. And it almost feels like you're better off investing through credit commercial real estate, or that's something we do very heavily, is where we're financing groups 60-70% of current value when they're acquiring assets or developing assets. It almost feels like that's a better spot to be than investing through the equity side, just because you're going to potentially you're going to be in a better risk-adjusted position, but probably make better returns.
Yeah. Let me tell you an example of where I was wrong on something recently, and it involves credit. Long term, you should see lower returns to be in the debt portion of the capital stack than to be in the equity portion of the capital stack. Forget about correlation as a measure of risk and different return indexes to think about risk. Just think it operationally. Something goes wrong in a property and you hold the equity, and the asset's underwater, you're wiped out. So you take on more risk there of default, as opposed to the lender. The lender, well, they can at least take the property, and so they get something back. So you got the two portions of the stack. There's more risk in the equity portion, and so for more risk, you should earn a higher return. it is the case that recently, in the last couple of years, the debt portion of the stack, and we have an index for closed-end funds looking at the debt funds, and those debt funds those closed-end, on senior lending, the mezz, distressed debt, they've been well ahead of the equity returns. So the low risk option is earning better than the high risk portion of the stack. To me, that says two things. One, money has to flow to the debt portion. That's just what's going to happen. But two, it says that the equity portion either wasn't priced properly, meaning cap rates should go up more, or they're waiting for economic growth to kind of grow into that situation and grow into the pricing that makes sense there. And that's what we're starting to see into the first quarter, with prices starting to improve. That was going to drive improvements in the returns for the equity portion of the stack as well. So internally, here's what I got wrong. Internally, I was saying, we should probably minimize our focus on debt products for a bit because the equity portion is coming back. And there are a lot of debt tourists in the investment management world right now, where they were raising money and investing in equity, and they couldn't put anything to work in equity, so they just went to their clients and just raised money from them still, and they're doing some lending, but they don't have the extensive operations to be managing debt like traditional lending groups. It's interesting when you see groups hiring people in with that lending expertise. Those are the ones I think that are really going at this for the long term, not just for the temporary play. But I think that temporary play, to focus more on the debt portion of the stack, if you have more uncertainty around the equity portion moving forward, I think now it says that continue on the debt side for a little bit longer.
Yeah, it's interesting because there's been a lot of groups trying to get into private credit, to your point. And there's, us as a firm, we've been doing private credit for the last 15 plus years. And it's interesting because we have the infrastructure, we have, loan originators, we have underwriters, asset management in-house. We do all the loan servicing in-house. So we're doing the master servicing, special servicing. And the reason I mention all that is a lot of these groups don't have that expertise. They have a person who has some experience maybe in some level of doing lending, but that person may not have been on the team 2 years ago, a year ago. They're not part of the culture of that organization. And to your point, they're sort of a tourist, right? They're a debt tourist trying to get in the business. And it's a dangerous game because they don't have the infrastructure to service this. And we're seeing this real time. And they're getting in over their skis in some cases. And what's causing in a lot of cases is they don't close when they get to the finish line. A lot of these deals are falling back to us. But it's at least from our perspective, it's a great time to, on the private credit side, if you know what you're doing, you have the infrastructure, and you're able to not only originate the loans like we can in-house, but you have the bank relationships because we have a whole capital markets team that covers the regional banks. There is a bifurcation. I think that's going to take place like anything else because, private credit, you would think it didn't exist until 2 years ago, the way the media talks about it, or 3 years ago.
Yeah.
But it's been around since the beginning of time. It's just, in my background, obviously, before starting Peachtree was on the banking side, so I probably have a different view of it all. But it's literally something we do really well. But I do think there's going to be some challenges for certain groups that don't know how to execute in a efficient manner.
And I do think that the private credit does offer a safety valve that might also help us with some repricing events moving forward. I mean, think about, we're moving into a new environment where the 10-year Treasury, even if we just stay at today's level, is going to be higher than everything from 2007. So all those deals, as they come back to market eventually, you're going to have some challenges because you're selling it to somebody who's probably in a higher cap rate than the past. And the financing isn't going to be as easy. And getting deals closed may be harder because people are going to be really a little bit more cautious on their underwriting. It's the same situation that we went through in the 1970s. 1970s, you had a similar situation where, it was more intense because the 10-year at one point was close to like 20%. We had a big spike and a big move in the cost of financing. I've read about some of this stuff, but you had more exotic loans from some of the folks outside of the banking world, more participation loan kind of stuff, folks taking a more nuanced approach to the capital stack, providing some higher risk capital in there just to make things close. Maybe there's opportunities for that on this kind of environment if you have a whole generation of assets that you don't have that higher exit cap. Maybe there's some other way through that with more creative financing. And look to what the people did in the 70s. If you have a friend who's a banker who was active in the 70s at some point, go grab them a cup of coffee and ask them what they did to survive, and think about how you can put those opportunities to work in the current market.
Yeah, that makes sense. If you were going to go make larger investments on the equity side today, is there certain property types that you would be more favorable to, just given the market trends that you're seeing take place across the different property types?
Yeah, here's the thing. Property types has been the focus of discussion in just about every call I've had when I go visit pension plans and endowments and sovereign wealth folks. They made a ton of money by rotating out of offices and into industrial. The industrial sector, there was a structural change. It's not just a COVID thing. It really started around 2015. Around 2015, cap rates for industrial properties started falling more than they did for offices, and now they're actually lower than office cap rates. That's a big reversal of history. And so that's been the focus of discussion when I go in and visit with these folks, because their thought is, well, what's the next sector to go through that kind of change? But I'm not sure there is, because that was a structural change of people understanding that the CapEx relative to the NOI was too high for offices. And this is all pre-pandemic stuff was happening. And people are starting to rotate away from there into industrial, just given that need for more logistics space. And so there was a broader economic change in terms of how space was used. And that was already happening. It was driving that rotation. And we're almost done with that in terms of, there's still high rates of growth of online shopping relative to in-store shopping, but it continues to narrow every year in terms of growth rates and gets closer and closer to just personal income growth. It's still growing faster online. There's still going to be some demand there. There's still some industrial demand that comes from that. But the huge initial spike in that excess demand from online shopping probably going to slow a bit. So you don't have that same kind of big structural change out there. Now, what could be a structural change? Does AI introduce a change? Maybe. It certainly made everybody excited about data centers, and there's a lot of folks trying to figure out how to play into data centers, though it's a crowded trade because there's just not much liquidity, there's not much selling, and with more money kind of going in through construction. So that's one thing that happens, but it doesn't have the same kind of big thematic structural change in the economy that the downgrading of offices and upscaling of industrial has, unless there's some other big shock like that to the economy. I'm not sure you can really win just by allocating to a particular property type now that you weren't allocating to before. I think instead, we're getting back to a market where it's the local fundamentals that matter more. It's about being in a market that has healthy demographics or some other type of growth. So I look at that in two ways. One, what are the demographically driven markets and what are the trends there in terms of retirees and different age groups moving into cities? We have the baby boomers retiring. That's going to have a real estate need in certain markets. That's one thing I would focus on. The other thing I would focus on, the economy moving forward. It's a knowledge-driven economy. There is a notion we're going to bring some manufacturing back here, but the manufacturing we bring back, the thing is, the United States is still a manufacturing powerhouse. We produce more than Korea, Japan, and a number of the other big global manufacturing groups. We produce more now than ever before. We just use fewer and fewer people to do it. So when we bring that back, it's going to have to be in certain types of markets that can accommodate the robots, the power requirements, the water requirements. So you got to be very selective in terms of locations. So I think the focus moving forward for everybody in the real estate world, do think about sectors that are important, and it's important and all, but I think finding the right assets in the right market, the cities that have the right growth story. The growth stories I'm looking at either the demographic growth or just if you're looking at manufacturing, just which markets have the right education base to deal with all the robots and manage the robots and all the manufacturing that's going to go on with them, they have the right power and everything. So I'm still looking at the education-driven markets, the medical-driven office, the eds and meds types locations. it's a knowledge-driven economy, so you got to go where the smart people are at. That's where the growth is going to be. The other growth, it's demographic growth of just baby boomers moving from one area to another, and there's some opportunities that come from that. But the real long-term growth, I think you just got to find where the smart people are at. They build the economy, and they'll have economic needs, and so they'll have real estate needs to go with it.
When you look out over the next 10 years, what cities do you think set up really nicely to have probably outsized growth into the rest of the U.S.?
There's a number of characteristics I'd be looking for. Having local universities that generate the degrees that are needed for the modern world. Not every university is the same. Doesn't mean you have to only get students from MIT and Harvard, but if all you're generating, if you're not generating the best grad students in engineering and design and all that you need for that manufacturing world, you're probably not going to get a lot of manufacturing jobs there. One way to look at that is actually look for not the universities, but look for the quality of the teachers at the universities, and they're all ranked. They're all ranked based on how they're being published and what journals are getting into. The best grad students flock to the best professors. There's a reason that of all cities, Pittsburgh became suddenly so attractive to investors because the local city leaders in Pittsburgh, they gave a darn about their city. They put their own money into putting really good professors there at Carnegie Mellon, both on the engineering and design side that gave us the driverless car stuff that really started to pop up there, and on the medical side, that's also a huge source of growth for that city. And with that investment in really smart folks at the local universities, the best grad students came in to Carnegie Mellon. I mean, that's just a treasure for that city. Without Carnegie Mellon, you would not have seen the rebound in Pittsburgh that you've gone through. So I'd be looking for the universities where they've started to decent sized cities where there's assets, and look for the universities where they've put the work into getting the right staff there. I mean, if you've got a local university, great, but if you don't have the top tier engineering and design professors there that would be needed in any kind of industrial activity moving forward, you're not likely to attract the kind of firms that would be growing afterwards. So you got to be thinking about sort of where are those happy alignments of the right talent moving forward.
So Jim, we're almost out of time. I really appreciate your insights and knowledge. I really like looking at the different presentations and data that you publish. This is very just interesting times, and it's very, very unpredictable what's happening and how the market's going to play out, just given a lot of the new policies that the administration is trying to potentially implement, and who knows how it's going to play out. But with that said, do you have any closing thoughts or anything as you look at the commercial real estate market over the next several years? Anything you want to share just as we close this out?
Yeah, I want to throw some optimistic thoughts out there because I feel like I've been talking a little bit about dour, like there's potential recession and everything. And yeah, maybe we do have a recession coming. Maybe the supply chain stuff is already starting to hit us and we don't even know it yet. Then maybe we do hit a recession. But here's the thing. There's always money to be made in a down market. Just because the market's going up doesn't mean that that's the only way to do things. When things slow, there's still an opportunity for growth. There's still things that need to be serviced. There's still clients that you're working with that you just got to be on top of things with them and communicate with them. And maybe it can be painful at times. Maybe there's job losses, and you just lean into your community a little bit more and position yourself for the next great growth opportunity. And the thing is, there will be some growth opportunities. The distressed debt funds are looking at some of our data. They're performing well compared to other groups as they try and clean up that mess of folks who are a little bit ahead of their skis. And that's where, if we do have an even stronger negative reaction moving forward, I'd be looking there. There's going to be opportunities. There's always opportunities for folks who can come in and clean up problems. But once problems get cleaned up, then there's still some growth opportunities, because the fundamental thing about performance moving forward, it's less of the financial engineering. It's more about the growth opportunities and managing our assets properly. So focus on those growth opportunities. And it's the stuff that you can actually control then in terms of how you lease and how you work with your tenants.
That makes sense. Really appreciate you joining and share that there's as choppy, volatile as an environment. And we're talking about the recession, to your point. I think there's a lot of positives, and there's a lot of opportunity in this market even today through the credit side I think we're seeing real time in banks, and we haven't talked as much about it today. A lot of the regional banks are starting to sell off exposure just to leverage their exposure and not have to deal with some of these issues. And we've been a beneficiary of that trade, as well as just a lot of great direct lending opportunities that we're taking advantage of, just given the volatility and the uncertainty in the marketplace. But more importantly, we're starting to see a lot of just special situations pop up. So I think it's going to be a very constructive environment this year if you're looking to invest capital into commercial real estate, where you may find some interesting opportunities. To your point earlier, maybe more in that localized manner. But I think, there's going to be some really, great opportunities that are going to come about, especially with that wall of debt maturities that's, starting to heat up this year as well. But again, thank you for joining, and would love to host you again. It's very insightful hearing what you have to say. So thank you for joining, Jim. And Daniel, I don't know if there's anything you want to say to close it out.
Yeah, no, I appreciate it, Jim. Thanks for all the insights. Thanks for the optimism in concluding the panel today. And, we really appreciate it. We appreciate the time.
Thank you all.
Thank you.
Thanks, everyone.
That's it for this episode of Peachtree Point of View. If you found value in the conversation, hit subscribe and share it with your network. For more insights, visit us at peachtreegroup.com. And until next time, keep crushing it.